Welcome to the Pro Ticker Deep Dive. Our mission today is to deep dive into one of the most significant structural shifts in modern finance. I'm talking about the massive regulatory pivot in 2025 that has just completely recast the fate of the fintech sector.
Yeah, digital payments, lending, crypto,
Yeah.
the whole thing.
Exactly. For years, this whole industry was just defined by what everyone called regulatory fog. Executives never knew which way the wind would blow or when the next enforcement shoe would drop.
And now that's just gone. The ambiguity is lifting.
So the central question we're tackling has fundamentally changed. It's not about if fintech will get regulated anymore.
Right, that ship has sailed.
It's now, can giants like PayPal, Block, and Coinbase finally use their scale to capitalize on this new clarity and just dominate?
I mean, what's fascinating here is just the sheer speed of it all. This is, and I'm not exaggerating, this is probably the most consequential period for fintech since the 2008 crisis.
What?
But the key difference now is the shift from, let's call it enforcement-driven ambiguity, where companies were just sued instead of given clear rules, to an environment focused on building actual solid regulatory frameworks.
And you can see the market is having a really hard time digesting this. It's a huge split. You've got Coinbase, the pure crypto play, up about 4% for the year. Seems like immediate optimism. But the payments giants are getting hammered. PayPal's down over 29%. Block is down over 32%. So the opportunity for you, the listener, is really hunting for that mean reversion moment.
The moment when those regulatory tailwinds finally push these other stocks back toward reality.
Exactly. Okay, so let's unpack this shift.
To really get why this is a structural change, you have to look at the macro backdrop. I mean, think back just 5 years. The whole conversation in D.C. was about banning crypto.
Or at least crippling it.
Right. And now it's literally embedded in the policy machinery.
And it was a concerted effort. I mean, the new administration came in with an explicit mandate to deregulate. We saw that executive order in January 2025.
And that order immediately translated into action.
Yeah, like the OCC rescinding that old guidance restricting banks from crypto custody. That just unlocked a huge new stream of institutional money.
And you have new leadership at the SEC, more sympathetic and stepping away from that previous combative stance.
But the real inflection point, that was the legislative sprint in July 2025. Everyone started calling it Crypto Week.
That's where it got really interesting. The most important piece of that was the Genius Act, signed into law July 18th.
Okay, so the Genius Act established the first federal stablecoin framework. That sounds technical, but it's a huge deal. Can you break down why that was such a massive green light for the sector?
It just creates certainty where before there was absolutely none. The law basically says stablecoin issuers have to maintain 100% reserves.
In safe stuff, right? Like U.S. Treasuries.
Exactly. Highly liquid assets. And it brings them under the Bank Secrecy Act for anti-money laundering standards. The biggest payoff here is that it opens a clear legal path for non-bank entities, like some of Coinbase's partners, to issue these stablecoins without constantly looking over their shoulder.
And this isn't even the end of it. There are still other tailwinds pending. You've got the Clarity Act, for example.
Which would finally classify things like Bitcoin as commodities under the CFTC.
Right.
And then you have FIT 21.
Right, that passed the House with 71 Democratic votes. That's aiming to end the agency turf wars that have just stifled innovation for years.
And zooming out, you've got the global context. The EU has MiCA, which is their big digital asset playbook. When Coinbase got its MiCA license in June, that was a massive de-risking event for them.
And we can't forget the economy. The Fed has cut rates twice this year.
Which is huge for lending and buy now, pay later products. It eases consumer debt, makes borrowing cheaper. It's a direct tailwind for Block and PayPal.
Okay, so let's turn to the clear winner in all of this so far, Coinbase. Trading strong near 265, it's clearly the most direct beneficiary.
And the core of their strategy really is stablecoins. That business was something like 15% of their revenue in Q1 of this year.
So the Genius Act basically took their base blockchain network from a gray zone risk
to sanctioned, protected infrastructure. Overnight, it's an enormous competitive advantage.
And the market absolutely loved it. The stock surged, 38% in 1 week after the Genius Act passed, and they got the MiCA license.
Yeah, and you're seeing analysts now call it the most misunderstood company in crypto. They see huge upside.
So why all of the optimism now?
It's those dominance vectors we talked about, but now they're all de-risked by regulation. They're the only pure-play crypto name in the S&P 500. They own U.S. retail. They run one of the fastest blockchains.
And the institutional money can finally come in.
That's the key. Their prime brokerage, is a secure on-ramp for hedge funds, pension funds, and with regulatory clarity, those big counterparty and custody concerns just melt away. They're selling safety now, not just speculation.
All right, let's pivot to a very different story. Block. This is a real contrarian opportunity, down over 32%. So if deregulation is so bullish, why is Block doing so poorly?
Well, that poor performance is the market's skepticism about its growth, which is exactly why it's a contrarian play. The structural change for Block is all about the economics of lending.
And the watershed moment there was March 2025.
The FDIC approval for Square Financial Services.
Explain what that means in simple terms. Why was that so important?
Before, Cash App had to partner with a bank to do any lending. That meant giving up a big slice of the profits and everything was slower. Now they have their own bank charter.
They control the whole process.
The entire lending lifecycle. This fundamentally changes their unit economics. It makes lending way more profitable, way more scalable.
And that scale is already impressive. Cash App Borrow, their short-term loan product, is already on a $2 billion annualized run rate.
Plus 1 million users for their BNPL card since February. It's growing fast.
It also helps that they're showing some discipline. They shuttered that music venture Tidal.
Exactly. And they raised their gross profit guidance for 2025 to 14.4%. They're focusing their firepower where it matters.
And when you look at the valuation, it just looks cheap. Trading at an 11.78 PE ratio. That's cheaper than Coinbase, cheaper than PayPal.
Analysts see that 35% upside because they're betting on the success of that newly empowered lending engine.
Okay, so our final player is PayPal. This is maybe the most controversial name of the three, also down significantly, about 29%. The sleeping giant.
Yeah, the skepticism around PayPal is intense, but the recent data suggests an inflection point might actually be coming. Q3 results beat expectations.
Right, on revenue and adjusted EPS. And management raised their full-year guidance, which suggests they see some real momentum.
But that momentum is hard-won. They are in the middle of this painful but totally essential technological renaissance.
Can you explain what this $300 million project is actually for?
It's necessary internal surgery. I mean, their legacy tech is old, it's slow. This whole project is about migrating everything to modern cloud-based solutions.
So they can compete with Stripe and the newer guys.
Exactly. It's costly. They took a $95 million charge in Q2 for this, but they have to do it to stay in the game.
And the surprising bright spot in all this pain has been Venmo.
Growing revenue over 20% in Q2. That's its strongest result in 3 years.
So just like Block, PayPal's trading near a 5-year low on its valuation. If they can execute this turnaround, consensus sees a huge upside.
Potentially the deepest value play of the three, if they pull it off.
Okay, so let's connect the dots. What does this all mean? The bull case seems pretty strong. The regulatory environment is unambiguously bullish.
Thanks to the Genius Act and those executive orders, yeah, it's a permanent structural shift.
And critically, the valuations for Block and PayPal are, frankly, cheap for what they are. And you have macro tailwinds like lower rates helping their lending products.
The way I have to balance that. The execution risk is massive.
Okay, lay out the bear case.
Well, on the political side, legislative gridlock has already stalled some of the other pending crypto bills. And there's always the risk of a political reversal in the midterms that could swing the pendulum back.
And then there's the company-specific risk.
Which is huge. Coinbase has to prove this institutional adoption is sustainable. Block needs to scale lending profitably without, credit quality falling apart. And PayPal has to finish this massive, expensive tech upgrade without losing more market share. The competition isn't sleeping.
And for anyone tracking the technicals right now, Coinbase is in a clear uptrend, trading well above its 200-day moving average. The market believes.
But Block is a different story. Still in a bearish pattern. It's struggling to find a floor.
And PayPal seems to be stabilizing. It looks like it's trying to build a base after that steep downtrend. Close above $70 with volume would be a big technical signal.
So look, the deregulation play is real, but it is uneven. Coinbase is leading because clarity legitimized its entire business model.
And Block.
Block has maybe the most compelling risk-reward right now. The cheap valuation plus that structural improvement in lending. That's a powerful combination.
With PayPal as the ultimate contrarian bet.
The biggest bet, but if they deliver on those internal targets, that 35 to 40% upside is definitely achievable.
So the regulatory door is wide open, but the next 12 months are all about execution. For you, the key is tracking whether these companies can actually walk through that door fast enough to justify believing that all this recent pessimism is actually a historic undervaluation just waiting to be corrected. See you all in the next Pro Ticker Deep Dive.